You're listening to AI Prism from Seoul Economic Daily.
If you started your career in Korea in the last 3 years, your money is working against you in at least 3 different ways right now, and most of your colleagues haven't noticed yet. It's Thursday, June 4. Let's talk about a trend affecting young professionals in Korea.
Jumping right into it, the recent rally in the KSPI, the Korean stock market, it's really forcing people to look closely at their retirement accounts right now. Total retirement assets just hit this massive national pool of 500 trillion won.
Wait, so that's about 357 billion US dollars, right?
Exactly. And out of that, ETF investments have reached like 48.7 trillion won, or roughly 34.8 billion US dollars. But there is a huge structural trap here for early career workers, especially those working at a K-ball.
Right, a K-ball being one of those massive family-controlled conglomerates.
Right. A lot of younger workers there are stuck in a DBA, defined benefit pension plan. That's the system where the company basically manages the money for you. But what people actually want right now is a DC, or defined contribution plan, where, you control the allocation yourself.
Oh, I see. It's almost like being stuck in a DB plan right now is like being forced to ride a tricycle while your coworkers in DC plans are just driving sports cars.
Yeah.
They actually get to navigate the market and capture those gains, which completely explains why individual retirement pensions grew by like 32.6% last year.
It perfectly explains it. People are tired of the tricycle.
Hmm.
But here's the catch. When you try to take control and be financially responsible elsewhere, the system kind of actively punishes you. We're seeing this bizarre inversion in personal loan rates.
Wait, what do you mean by inversion? Because, if I have a top-tier credit score, say 900 to 1,000, I'm mathematically the safest bet for a bank.
You'd think so, yeah. But those top credit tiers actually saw the sharpest unsecured loan rate hikes. Meanwhile, the rates for the lowest credit tiers actually dropped down to 8.07%.
Wait, really?
Mm-hmm.
How are banks even justifying charging their safest borrowers more?
Well, they're justifying it through government policy. Basically, government-backed welfare loans insulate the lower tiers from market rate movements. So because banks have to offset those subsidized rates, they're forced to just pass the standard market hikes directly onto their most creditworthy borrowers.
That is wildly frustrating.
Yeah.
And it's worse because higher borrowing costs are hitting right as the rental market is, mathematically turning against you. We're seeing a massive shift away from Jeonse.
Oh, absolutely. The Jeonse market is collapsing.
And just for context, Jeonse is that uniquely Korean system where tenants essentially loan the landlord a massive lump sum deposit instead of paying monthly rent, and you get it all back at the end of the lease.
Right, but available Jeonse listings in Seoul just dropped by 30.7%.
Yeah.
Landlords are rapidly shifting to monthly rent. So now, a staggering 75.1% of Seoul's non-apartment rentals like studios and villas are monthly contracts.
Oh, wow.
Yeah, and they're averaging around 562,000 won, which is about 401 US dollars every month.
So if you're a young professional, your baseline living costs are suddenly skyrocketing. And with that happening, you'd really hope your company's making enough to hand out solid bonuses. But there are macro headwinds there, too. The U.S. just proposed tariffs of up to 12.5% on Korean goods.
Yeah, which is a big deal.
So does this mean export sector bonuses are basically doomed?
Well, the blow is definitely softened depending on the industry. There are some vital carve-outs to know about. Major export drivers like autos, batteries, and steel are actually excluded from this tariff completely.
Okay, well, that's a relief for those sectors at least.
Okay.
But still, when you stack it all up, rent is replacing Jeonse, your good credit gets you higher loan rates, and your retirement might be stuck on a company tricycle. People are going to panic.
Exactly, and that compounding financial pressure is pushing young professionals to look for risky shortcuts, especially in a bull market. Investment fraud actually doubled to 72,000 frozen accounts recently.
72,000. That's insane.
Yeah. A lot of it is driven by what they call writing chat rooms. They're these simulated stock tip groups that trick young investors into transferring funds.
What blows my mind is that while this specific type of fraud is doubling, banks' real-time fraud detection actions actually dropped by 21%. So just as people are getting desperate, the digital safety nets are literally failing.
Which really highlights the core issue here, right? Since the entire system is structurally passing market risks directly onto the individual, whether that's housing shifts or loan rates, blind loyalty to traditional financial paths is now a literal liability.
That's today's AI Prism, early career. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a One IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.